In this update, I'm going to discuss the fund's investment activities, some of the challenges faced in investment markets over the year. I'll then discuss investment performance and end with a few examples of investments that we've added to the portfolio that we believe improve the future return prospects for our members. Now, over the year, the fund has continued to invest in people and technological solutions with resources added within our shares, fixed income, infrastructure asset class team. We've also integrated more technology solutions to advance our operational efficiency and improve forecasting capabilities, which we utilise as part of our asset allocation framework. This is foundational work which enhances our portfolio decision making. Navigating the investment environment has been challenging as we've transitioned from over a decade of disinflation, low interest rates, and now into an environment of high inflation, high interest rates. Most central banks around the world have been tightening monetary policy over the year. We've seen geopolitical tensions rise and continue to emerge, and all these elements are creating a high degree of volatility or uncertainty in markets. The US continues to be an outlier with continued economic growth, whilst Europe, China and Australia have experienced declining growth metrics. The signals of slowing inflation are very clear across the manufacturing sectors of the economy, yet the enormous monetary and fiscal stimulus measures introduced by governments and central banks during the COVID-19 pandemic are yet to be fully spent by consumers and are most evident in the service sector inflation readings. Combining this residual stimulus with factors such as higher energy prices, full employment, geopolitical events and environmental events disrupting food production, inflation remains above central bank target levels, and many economists are arguing that the new neutral rate of interest will be higher in the future. The speed in which monetary policy has been applied is largely unprecedented in recent history, and after the effects of these increases are likely to see many casualties in the economy, including a higher chance of a recession in 2024. Now, shares have fallen along with long duration bonds as rising interest rates result in investors rethinking their future expectations. This coloured quilt chart shows the performance of the sectors in which we invest over each calendar year. The new financial year brought with it higher volatility as economic activity slowed down due to money supply continuing to be removed from the market, and we saw that financial stability within the US banking system was tested with the fall of Social Ventures Bank and a number of other small regional banks. We've seen default rates on credit continue to rise and new housing development declined, which is all symptomatic of an environment in which central banks are hiking interest rates and governments are reducing spending. The last column shown here shows us leaders in our sectors that we invest in as of October of this year. We can see that growth alternatives, private equity, infrastructure and cash are the top performing asset classes year to date, whilst listed infrastructure, bonds and listed real estate are all the weakest. The change in leadership within these various sectors really demonstrates the importance of diversification within a portfolio. However, over the long term, shares generally outperform other asset classes, and this is why it's really important we have a high allocation to these asset classes within our diversified MySuper product. Now just moving on to our Carbon Neutral 23 update. We continue our efforts to build a resilient portfolio that avoids sectors and companies that we believe will become stranded, thereby losing value or are less competitive in the future. This is illustrated in this chart, which we show the decarbonisation projections for our diversified MySuper option. Now, I'm really pleased to report that we have already achieved our interim 35% reduction of carbon emissions 2 years ahead of schedule. The current carbon intensity at our latest reading this year is even below the target by 12%. Now, this represents a 47% reduction in carbon intensity of our portfolio from 2021 levels. The dotted pink line shows our actual carbon intensity against our projections. We also show the upper and lower bounds of what we predict our carbon intensity to be by 2030. We are forecasting that there will be a residual carbon position by 2030, and we are currently reviewing a variety of carbon offsetting investment opportunities. Now, if we can't get comfortable with these carbon offsetting investments from a risk and return perspective, then we need to recast our carbon neutral timeline beyond 2030. It's too early to make this conclusion. However, we do expect to have a firm position on this within the next 12 months. The important thing to remember is that we will always prioritise the best financial interests of our members. So how is the NGS portfolio positioning to weather the current economic environment? War, recession, inflation. How are we to interpret asset class returns? Now, this matrix outlines our scenarios we've applied to markets and asset classes over the 6 to 12-month time horizon. These scenarios help us determine the likely return we could expect to receive on the various asset classes in which we invest, such as shares, fixed income, infrastructure, real estate, commodities and cash. A darker green colour indicates a positive view of an asset class, whereas a red colour indicates a more negative view. Each scenario results in the asset class return forecast being weaker or stronger. Cash and commodities tend to perform well in most scenarios outlined here. To the first question, will the war between Hamas and Israel escalate? Well, from an asset allocation perspective, we believe it's likely contained in the Gaza Strip in the near term, and we assign a higher probability to this outcome. A key indicator of escalation will be whether Hezbollah joins the fight against Israel. Otherwise, the events may prove isolated to the Hamas and Gaza Strip for now. This lands us between scenarios 3 to 6. And in these scenarios, we see commodities and cash being the best asset classes, followed by fixed income. So what is the probability of a recession in the next 6 to 12 months? Well, we're seeing credit conditions tightening, excess savings are closely to fully depleted, and we're beginning to see cracks in the system. And the likelihood of recession in the second half of 2024 is increasing. This is based on our view that the war will not escalate and therefore reducing the speed of a recession outcome. However, if the war does escalate, then a recession will likely occur earlier. So what to make of fixed income market conditions? Now, the market has priced in a 5.25 to 5.5% US federal funds rate, so the interest rate in the US. And they expect the Federal Reserve to hold rates constant until mid-2024, before the first cut. Economists around the globe are debating what the neutral rate of interest rates should be. And this relates to whether you perceive that we are in a new regime or not. Now, we would argue that we are in a new regime and interest rates will be higher going forward, despite secular stagnation remaining the consensus view. So how do we position our portfolio in the current environment? Well, we certainly continue to maintain an investment in shares, but we're adding greater defensiveness in our portfolio. So that's the posture that we're taking at this point in time. And how does Australia compare to the rest of the world? Australian households have around $239 billion in excess savings, but real wage growth remains negative, indicating further depletion of those savings. Australia doesn't have excess labour demand like the US, but still has very tight labour markets by historical standards. The Australian mortgage market and mortgage rate moves up with RBA in lockstep, while the US mortgage rate is largely fixed. Therefore, consumers, and by the extension the economy, is more sensitive to the impact of higher interest rates in Australia. Now, what do we make of currency and commodity markets? The fair value of the Australian dollar still points to a level around 70 cents per US dollar. However, given the recent geopolitical risks and rising US interest rates, the Australian dollar may fall from current levels. On the commodity side, the stable demand and shock to supply will likely put a floor under oil prices, and gold is likely to perform well in this environment. And we foresee that we'll continue to hold or add to our gold position over the next 12 months. Now, this matrix takes it a step further and translates our current short-term asset allocation views across the various asset classes in which we invest. You can see that we are neither negative or positive on shares and bonds. However, we're slightly negative on high-yield credit and emerging market credit. We are positive on safe haven currencies such as Japanese yen and US dollars, and positive on cash, and continue to see good value in our infrastructure portfolio. So in essence, we're staying invested in risk assets, so shares, and we're adding additional hedges to solve for an uncertain outlook. In summary, our asset allocation is in line with our strategic asset allocation, which indicates we are neither positive or negative relative to our strategic asset allocation. However, we continue to add these hedges to our portfolio, such as gold. Over the medium to long term, gold provides a clear hedge against geopolitical risk and second wave of inflation and deep recession. We've increased our allocation to international fixed income. Bonds now act again as a diversifier in the case of a deep recession as yields are more attractive. We're maintaining a higher exposure to US dollars as part of our foreign currency exposure. This provides a hedge against continued hawkish Federal Reserve and further geopolitical tensions. And we're frequently rebalancing our portfolio. As the recession approaches, we are still invested, however we're taking profits and locking those gains in quicker. Now just moving on to fund performance. Performance for the financial year was strong, with a diversified option returning a solid 8.54% for the accumulation division and 9.75% for the pension division. These strong results were predominantly delivered from strong share market returns, which you can see on the left-hand side of this chart. International shares contributed 5.58% and Australian shares contributed 3.91%. The largest negative red bar on the right related to the depreciation in the Australian dollar relative to major OECD countries, but primarily the US dollar. Private equity is an asset class in which we invest and is a large part of our portfolio, with close to $1 billion invested in this asset class. Now, this is an extremely attractive portfolio of assets whereby we can select investments that we believe will generate strong returns and in many cases address some of those significant social problems or have emerging technological solutions that don't currently exist in the market. This is a long horizon asset class in which we need to stay invested for up to 10 years. Now, these are unique investments that the fund makes that aren't available to retail investors or available on share markets around the world, and are extremely valuable to member returns in the portfolio. We've been able to access them through our strong relationships that we've cultivated with global investment managers over our 35-year history. Our base case return for this asset class is 15%. Now, this represents approximately a 7% premium to listed share market returns. We continue to seek out direct investments that allow us to lean into secular themes such as space, artificial intelligence, feeding the population, climate change, healthcare, and quantum computing, to name a few. Now, the 6 images that you can see on the screen make up a part of our portfolio. Some of these are via fund investments or direct investments that we've made. In the domestic market, we've recently acquired interests in Boost Juice and Betty's Burger, and Pack Trading, which is a trading company that produces biodegradable packaging for the food industry. We have also exposure to rocket companies, satellite companies, quantum computing companies, drug discovery and bioagricultural companies, amongst the many exposures in our portfolio. And in many cases, these companies have patent technologies that are disrupting existing technologies. Now, just moving on to infrastructure. NGS has invested with a Clean Energy Finance Corporation, BlackRock Alternatives and other investors to build the Waratah Super Battery in the Hunter Valley in New South Wales. Now, the Waratah Super Battery is a system integrity protection scheme designed to act as a shock absorber in the event of any sudden power surges, including from bushfires or lightning strikes. The Waratah Super Battery is one of the largest committed battery energy storage in the world, and investments such as these support NGS Super's target of creating a carbon-neutral investment portfolio by 2030. The good news is there are low fees on this investment, and the base case return that we have is 10% per annum. Again, on infrastructure, we've made an investment in 2 electric vehicle charging businesses in the UK and Europe, PowerDot and Raw Charging 2. Many European countries and the UK have ambitious targets for reducing greenhouse gas emissions and promoting the adoption of EVs. As a result, governments are supporting the deployment of EV charging infrastructure through grants, subsidies and other incentives, and we can make investments in these sectors which are very attractive. EV charging stations can generate revenue through a variety of business models, including pay-per-user, subscription services, or partnership with retailers or other businesses. The attractive thing of this investment is there are no fees, and the return profile again is attractive with a base case return of 10% plus. Another recent infrastructure investment that we've made is in Serenitas, which is a leading owner, developer and operator of Australian residential land lease communities. NGS Super has invested in Serenitas alongside Pacific Equity Partners. Now, we have a strong relationship with Pacific Equity Partners, and their value-add process will generate strong returns with, again, the base case return of 10% per annum. Land lease communities have a different buying model to a classical house and land purchase. Essentially, the buyer leases the land from the community developer but owns the home that they build or buy on. Lend-lease communities are seen as an alternative retirement living option due to their comparative affordability, as owners avoid stamp duty and council rates and pay no or low exit fees, and of course receive the government rent assistance payment. With the growing cost of living pressures, land-lease communities are emerging as an alternative retirement living choice that allow people to release capital to purchase a lifestyle in lifestyle-rich areas. Another recent investment that we've made in our infrastructure portfolio, LMS Energy, Australia's and New Zealand's largest landfill gas operator. Landfill gas management and destruction is a key decarbonisation enabler, as methane has 25 times higher CO2 greenhouse gas effects than CO2 alone. NGS Super invested in LMS Energy alongside fund manager Pacific Equity Partners. Now, LMS Energy have a long-term contracts in place with an average weighted contract expiry of 23 years and a 100% track record of renewal. Waste to energy is a segment supported by favourable government policies such as carbon credits, and this investment gives NGS the opportunity to invest in the number one player managed by a strong management team. Again, we have attractive return profiles with this investment offering a 10% base case return. Now just quickly talking about our property portfolio. Our industrial property portfolio was established in 2012 and benefits from strategic locations across the eastern seaboard. Industrial property includes warehouses and has been the premium asset class since the pandemic. The fund has over $500 million of industrial assets located in metropolitan areas of Sydney, Melbourne and Brisbane, and we have 21 properties incorporating the potential for residential land rezoning in Sydney, land banking in Brisbane, and development opportunities for expansion of existing and new building sites in Melbourne. This portfolio has delivered an 11.72% per annum return since the portfolio was established, and this is as at the latest performance report of September 2023.